Alright, let's talk about BlackRock. You have probably heard the name thrown around, maybe seen some wild conspiracy theories online, or heard people say that they are buying all the houses or secretly running the world. But what actually is BlackRock and why should you care? Because the real story is actually more concerning than the conspiracies, and it has nothing to do with evil masterminds or secret mans. It has to do with something much simpler and much harder to fix: concentration of power. So let's start from the beginning. What is BlackRock? BlackRock is an asset management company. Now, I know that sounds like boring finance jargon, but let me put it simply for you. When you save money for retirement, you basically have two options. You can try to invest it yourself, picking stocks and bonds, and hoping you make good choices. Or you can hire a professional to do it for you. That professional is an asset manager. They take your money, invest it in various things like stocks, bonds, real estate, and they charge you a small fee for this service. BlackRock is the biggest asset manager in the world, and when I say biggest, I mean absolutely massive. They manage about 12.5 trillion in assets. To put that in perspective, that's more than the entire economy of Japan. That's more than Germany's GDP. It's an almost incomprehensible amount of money. But here's the crucial thing that people get wrong. BlackRock doesn't actually own that money. Think of them like a parking garage. When you park your car there, the garage has your keys, they are holding your car, but it's still your car. BlackRock holds and invests money for millions of regular people with 401ks, for pension funds or big institutions, even for governments. That money belongs to those people and institutions, not to BlackRock. But here is why it gets interesting. Even though they don't own the money, they do control how it's invested, and they vote the shares on behalf of the people whose money they are managing. So how did the company get started? The story actually begins with a massive failure. In 1986, a guy named Larry Fink was working at a financial firm called First Boston. He was a rising star, making huge bets on bonds and mortgages, and then he lost $100 million in a single trade because he miscalculated interest rate risks. $100 million gone. He got fired, career over. Most people would have given up, but Fink had a realization. He didn't lose the money because he was stupid or because markets are random. He lost it because he didn't have good enough technology to understand and measure the risks he was taking. So in 1988, he decided to start a company with one massive mission: use cutting-edge computer technology to deeply understand investment risks and build more stable, secure portfolios. They called it Blackstone Financial Management, which is why it's so easy to confuse with Blackstone, the private equity firm. They gave him $5 million to start with, and eventually the company split off and it became just BlackRock. Fink's biggest insight was that most investment firms at the time were still doing things the old-fashioned way. Lots of gut instinct, not enough hard data. BlackRock was going to be different. They built a sophisticated computer system called Aladdin that could analyze risks like nothing else on the market. Every possible scenario, stress testing portfolios to see what would happen if markets crashed, if interest rates spiked, if a recession hits, whatever. The system became the foundation of every BlackRock does, and we'll come back to why that's important later. Now, let's talk about how BlackRock went from a small startup to the most powerful financial institution in the world. Through the 1990s and early 2000s, BlackRock grew steadily. They were simply better at managing risks than their competitors. And word got around, they started buying up other investment firms, consolidation, getting bigger. But the real turning point came in 2008, where the financial crisis hit. The economy was collapsing, banks were failing, the government was in full panic mode. They needed someone who could help them figure out what all these toxic assets were actually worth and how to manage them. And who did they call? BlackRock. The US government contracted BlackRock to manage toxic assets from failed firms like Lehman Brothers and Bear Stearns, and to help manage the Federal Reserve bond buying program. Now you could ask, was this fair? Was this corruption? Not necessarily. When your house is on fire, you call the best firefighter, not the cheapest one. BlackRock had the technology, they had the expertise, they had that Aladdin system that could actually analyze this stuff, but it did raise questions about contracts being awarded without competitive bidding and about the very close relationship between Larry Fink and senior government officials. But here's the key: after 2008, BlackRock reputations exploded. They were seen as the firm that helped save the economy. Trust in them went way up, and more trust means more money flowing in. Then in 2020, when COVID hit and markets were crashing again, guess what? The Federal Reserve turned to BlackRock once more to help purchase distressed securities. At this point, BlackRock wasn't just big, they were the firm that governments trusted in a crisis. They had become essential infrastructure. But the government contracts alone don't explain how BlackRock got this massive. The real reason is their business model and timing. Traditional actively management stuff charge you around 1% or 2% of your money every year to manage it. That might not sound like much, but over decades, this adds up to a huge chunk of your retirement saving. BlackRock's index funds charge as little as 0.03%. Think about that. If you are a regular person saving for retirement and one option costs 1% and the other costs 0.03%, which would you choose? It's a no-brainer. So people flooded into BlackRock cheap index funds, and here is the beauty part of their business model. The bigger they get, the cheaper they can make their fees. They can charge less than everyone else, which brings in more customers, which makes them bigger, which means they can charge even less, which brings in even more customers. It's the Walmart strategy applied to investment. Scale creates efficiency, efficiency attracts customers, customers create more scale, and all of this happened right as the investing world was going through a massive revolution. For decades, people paid expensive fund managers to try to pick winning stocks and beat the market. But study after study showed that most of these expensive managers don't actually beat the market. They might beat it once a year, but over time, they usually underperform a single index fund. So investors started asking, why am I paying someone 1% to fail at beating the market when I could pay 0.03% for an index fund and get better results? Trillions of dollars started shifting from actively managed funds into passive index funds. And BlackRock was already the biggest player in index funds, so they captured most of that tidal wave of money. Today, BlackRock, Vanguard, and State Street, just these three companies manage over 90% of all passive equity fund assets. These three firms control over 20% of the total US market capitalization and are the largest shareholders in 88% of the S&P 500 companies. Let me say that again. Three companies are the largest shareholders in 88% of America's biggest corporations. Now, you might be thinking, okay, so they are big, so what? They got big by being good at what they do, by charging lower fees, by helping people save for retirement. What's the problem? And that's exactly what I want to talk about. The problem isn't that BlackRock is evil or that Larry Fink is some villain trying to control the world, even if he is, which I'm not denying. The problem is structural. The problem is that this much power concentrated in one place is dangerous, regardless of who holds it or what their intentions are. Let me start with a simple question. Should any institution control this much of the economy? Forget about BlackRock for a second. Imagine if one company controlled electricity for 88% of American homes. Even if that company has the best engineers, even if they followed every safety regulation perfectly, even if they had backup systems and redundancies, that would still be terrifying, because if something goes wrong, everyone is affected at once. There is no diversity, no backup, no alternative. That's exactly what we have with BlackRock and the big three asset managers. Let me walk you through the specific ways this concentration creates risk and why it should worry you, even if you think BlackRock has good intentions. First, there is the technical risk. Remember that Aladdin system I mentioned, the one BlackRock built to analyze risk? That system now manages 21.6 trillion in assets. That's roughly 10% of all global financial assets running on one computer system. Now BlackRock will tell you it's incredibly secure. Multiple data centers, redundancies, backups, false safes, and they are probably right. It's been running for over 30 years without a catastrophic failure. But here's the thing about systematic risks. The fact that something hasn't failed yet doesn't mean it can't fail. The Titanic was unsinkable until it wasn't. Tech companies with massive security get hacked all the time. Even NASA has had critical computer failures. What happens if Aladdin crashes during a market panic? What if there is a bug that nobody found? What if a foreign government manages to hack into it? If 10% of all the global financial system goes offline at the same moment, that's not just BlackRock problem, that affect everyone. Your retirement account, your pension, your bank, everything. One point of failure for 10% of the world financial system. Second, there is the competition problem, and this one is subtle but really important. BlackRock is the largest shareholder in 88% of the S&P 500 companies. That means they own pieces of direct competitors. They own shares in American Airlines, Delta, United, and Southwest. They own Coca-Cola and Pepsi. They own Ford and GM. They own JP Morgan and Banks of America. Now think about what that means when they vote as shareholders. Are they pushing these companies to compete aggressively against each other, or are they kind of okay with it, with all of them making comfortable profits? Because either way, BlackRock benefits. This isn't just theoretical. Research has found that common owners of airline stocks called on Southwest Airlines to boost fares and cut capacity. That's literally telling them to compete less aggressively. Now, other research have pushed back and said the evidence for anti-competitive effects isn't conclusive, and that's fair. Academics genuinely debate this, but here's my point. Even if BlackRock never abused this power, the potential for abuse exists. The structure itself creates the possibility. It's like giving someone the keys to your house. Maybe they are trustworthy, maybe they'll never abuse it, but should they have the keys at all? Even if BlackRock has the best intentions, the concentration of voting power over competing companies is a structural problem. Third, there is the too big to fail problem. Remember 2008, big banks became so important to the economy that when they made catastrophic mistakes, the government had to bail them out with taxpayer money. Of course, they were too big to fail, so regular people ended up paying for their mistake. BlackRock is now in a similar position. When the crisis hit in 2008 in 2020, the government turned to them. They are essential infrastructure now. So here's the uncomfortable question. If BlackRock ever made a huge mistake, could the government afford to let them fail? Or are they so woven into the financial system that taxpayer would have to bail them out? And if they are too big to fail, that creates one economical moral hazard. If you know you'll get bailed out, you can take bigger risk because you won't fully bear the consequences. I'm not saying BlackRock is taking reckless risk right now, but the structure creates that initiative. The structure makes it possible. Fourth, and this is the one that keeps me at night, there is systematic cascade risk. These three firms are the largest shareholders in 88% of the S&P 500 companies. That means they are all interconnected. If BlackRock makes a mistake, it doesn't just affect one company or one industry. It affects most major companies across all industries simultaneously. Think about 2008. The financial crisis spread so fast, partly because all the banks of America were interconnected. They all owned similar toxic assets. When one bank failed, it creates a domino effect. Now imagine that, but with 20% of the entire stock market. It's not like having 3 eggs in one basket. It's like having one basket that holds most of everyone's eggs. If that basket drops, we will all feel it at the same time. Now, that is BlackRock, not a conspiracy, not a cabal of evil masterminds, just the logical end result of market forces that naturally concentrate power. And that might actually be more concerning than any conspiracy theory, because it means this isn't about stopping bad actors, it's about recognizing that we have created a system with structural vulnerabilities baked into how it works. The question isn't whether the people running BlackRock are good or bad, the question is whether any institution should have this much power over the economy, and what it means that our financial system naturally creates these concentrations power. Because right now we have 3 firms controlling the voting right in 88% of America's biggest companies, managing 90% of passive investment funds with 10% of global financial assets, running through one computer system, and we are all just hoping nothing goes wrong.